Hey everyone, welcome into our latest TDR Podcast. I'm your host, Shad Dales, and today I'm diving into a major shift in the investment world. And if you're in the markets, you need to pay attention to this. Exchange-traded funds, or ETFs, are now massively outpacing mutual funds. But is this just a passing trend or a total redefinition of how investors are trading? And are rookie retail investors, maybe people like you, unknowingly taking on more risks than they realize? But before we get into today's video, currently 20% of our audience that consumes our content is subscribed to our channel. So greatly appreciated if you could like this video and also subscribe to our channel. We'd appreciate it as we try to increase those numbers and grow this community. And now with that, let's get into today's video. So let's first start with the numbers. In 2023 alone, mutual funds saw net outflows of $462 billion. In contrast, ETFs have net inflows of over $539 billion. That's nearly $1 trillion swing in sentiment. And according to BlackRock, that shift has accelerated in Q1 here in 2025. From millennials to boomers, investors are pulling money out of traditional actively managed mutual funds and reallocating into ETFs. So the big question is why? First comes efficiency, control, and most importantly, cost. But before we jump into the pros and cons, let's explain the key differences. A mutual fund pools your money with other investors and is managed by a fund manager. You buy or sell shares once per day after the market closes, and you typically pay higher fees for professional management. An ETF, on the other hand, trades like a stock on an exchange. It can be bought or sold at any time during market hours and often tracks an index like the S&P 500 or the NASDAQ passively. So really, what are the advantages of ETFs over mutual funds? First thing comes to mind is lower management fees. The average ETF expense ratio is 0.16% versus mutual funds at 0.44%. There's also real-time pricing and liquidity, along with greater transparency, knowing many ETFs disclose holdings daily. And then there's tax efficiency via in-kind creation and redemption. In short, ETFs give you flexibility and transparency at a lower cost. But here's where it gets interesting and potentially risky, especially for rookie retail investors. The ETF boom isn't just driven by institutions or seasoned investors. It's also being fueled by a new class of self-directed app-based traders, people using Robinhood, Wealthsimple, or even crypto profits to diversify into ETFs. And here's the risk. Just because it's called an ETF doesn't mean it's safe. We now have thematic ETFs targeting niche sectors like cannabis, AI, clean tech, space travel, even blockchain gaming. These funds might sound very exciting, but they can carry extreme volatility, limited liquidity, and sector-specific downturns. And these sectors do have downturns. In 2021, the ARK Innovation ETF gained over 150% during the pandemic tech rally, but in the 2 years after, it lost 60%. So ETFs are tools, not shortcuts, and using them responsibly takes strategy. Now let's move on to tax efficiency and cost clarity. One of the most underappreciated benefits of ETFs is tax efficiency. ETFs rarely distribute capital gains because of how shares are created and redeemed. They use in-kind transfers instead of selling underlying securities. This is a big win for high net worth individuals who want to manage tax exposure, especially in non-registered accounts. And don't forget cost. A mutual fund might charge you 1.5% annually. With an ETF, you might pay 0.05%, meaning over time, you keep more of your return, which makes sense. But keep in mind, with all this growth comes hype, and hype brings risk. And here's some examples. First, liquidity illusion. Just because you can trade it doesn't mean you should. Some niche ETFs have very low and wide ask spreads. Also, there's tracking errors. Not all ETFs perfectly follow the index they claim to mimic. Small slippage over time starts to add up. And then there's leveraged ETFs. These are not for beginners. They use derivatives to amplify returns and losses, often resetting daily. And here's a stat that might surprise you. More than 50% of ETF investors under 35 couldn't explain what's actually inside the fund they're holding. That is a huge educational gap. So really, who's leading the shift in all this? Look no further than institutions, because they're adapting fast. Banks are offering model ETF portfolios as well. Investment advisors are also shifting clients into ETFs to manage costs and increase transparency. And asset managers like BlackRock and Vanguard are doubling down on ETF product development. And here's a stat: ETF assets under management surpassed $430 billion this year and are projected to cross $500 billion by mid-2026. Mutual funds, in contrast, flatlining. So here's the bottom line: ETFs offer freedom, flexibility, and lower costs, but that doesn't mean they're risk-free. Understand what you're buying, don't chase the flavor of the month, and always align your investment with your goals. If you're new to investing, ETFs can be a great place to start, but do your homework. The wrong ETF in the wrong hands can do more harm than good. So that's it for today. If you got value from today's breakdown, smash that like button, subscribe to our channel, and drop your questions in the comments. What ETF trends are you watching? Let's talk about it. In the meantime, like I always say, stay open-minded, stay connected, and I'll see you next time on our latest TDR podcast. I'm your host, Shad Dales. Thanks again for watching.